Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock with news: a global recession now seems almost certain. Wall Street has opened the week in full fear mode with a large-scale retreat underway, the worst since 2011. In fact, at one point, the New York Stock Exchange briefly halted trading for the first time since 1997 to allow traders to catch their breath. Every media outlet is recording the crash, but we will focus on what it means for New Zealand. But to set the scene, the S&P 500 is currently down 7.5% so far today, taking its 2020 retreat to minus 16%, and since the peak to minus 19%. They're following Europe, which was down almost 8% overnight, and in turn they followed Shanghai, Hong Kong and Tokyo, which all posted huge retreats yesterday. Locally, the ASX 200 crashed 7.3% and the NZX 50 Capital Index fell a more modest 2.9%. Benchmark bond rates have collapsed too, to unprecedented levels. The fear that grips markets is one where investors are focused on the return of their money, ignoring the return on their money. And although these benchmark yields are now very low, market interest rates seem to be rising. Junk bond yields are rising fast, reversing their trend. And even investment-grade corporate debt yields aren't now falling anything like the government bond rates. Essentially, risk premiums are rising, and for private transactions, expect them to rise as investors demand fattened premiums for taking lending risks in this environment. In China, heavy equipment makers are reporting a 30% drop in the use of their machinery, reinforcing the slow pace of getting industry back to work there. Australia and New Zealand's exports to China are getting more attention from policymakers worldwide, as these exports will show how fast the world's second largest economy is recovering. And there are positive signs, but China may no longer be the real economic problem. The world's problem is having the correction it needed to have, and the one it's been put off relentlessly by fiscal and monetary authorities. Events are overrunning them with now depleted ammunition. The economic clean-out has begun. It will end after some considerable pain, but economic fundamentals should be in a better place then. The pain is very likely to include substantially lower asset prices. Meanwhile, the IMF is warning about slow government responses to the intensifying economic bailout. It wants to see bigger, faster and targeted responses from the major economies. The fear has extended to flying, and the world's airlines are in crisis mode. But nothing reveals the flight to safety like the crash in yields for benchmark US Treasury bonds. The US Treasury 10-year yield is now just on 0.49%. which fell 28 basis points from this time yesterday, confirming off-market trading yesterday. Remember, this yield was at 0.92% on Friday and 1.30% on February 27. And gold has actually moved very little, and that small change was actually a fall of $3 to be now at $1,670 an ounce. Go figure. US oil prices are sharply lower at just on $33 a barrel, and the Brent benchmark is also lower at $36 a barrel. Both of these are small bounce backs from about $3 from the levels we saw yesterday. A year ago, New Zealand was paying $65.60 a barrel. And the Kiwi dollar will start today substantially stronger, in fact at a 3-week high. It is up to 63.8 US cents. The greenback is getting trashed. On the cross rates, we're now at 96.4 Aussie cents and a 5-week high. Against the euro, we're little changed, however, at 55.6 euro cents. That means our trade-weighted index is now at 68.1 and a net minor gain. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.